Good morning, fellow friends and traders. I'm here doing a recording for Friday's action to take you through all the steps I do, all the tools I use. Now, I'm going to do something a little different. I'm going to probably guide it in terms of optimization of really what you can make if you do things right and what should be done, based on what I teach. But in the heat of battle, it doesn't always work out that way. But I'm going to try and present it with the idea that we can really utilizing hedging, parlaying, make enormous amounts of money, especially in these non-volatile days. And I'll take you through the steps of what we can do. And remember, no one out there has done this, and no one will do the trades the way I'm going to talk about them today, the way they could have been done, and maybe end up making $30,000 if you did everything perfectly. But believe me, $10,000, $15,000, $20,000 is very realistic when you're looking at this kind of action. So just be aware of that caveat. Now, we open somewhere. I'm going to start moving the mouse. We open somewhere here around the highs of the previous day. And before I started the day, I sent out an email. We're looking to do puts because the puts are extremely cheap relative to the calls because they're slightly out of the money. And we're looking at puts opening at 65 cents. So basically, we're looking to buy 65 cents scale in. And the market opens up the ADs, the advanced decline, very significant indicator, by the way. The advanced decline line will confirm or not confirm moves. So here we are. We test up against yesterday's high, Thursday's high, and we come down. First thing we do is we come down from 39 roughly to 37. And it's a small 60% retracement of yesterday. Okay, and I make a comment, inflation and rate increases may start to worry G20 meeting, which is going on this weekend. Okay, people are getting concerned. There's horrible, people are really concerned. In fact, I was just reading a headline from CNBC. I publish, I publish a lot of papers, and it says fear of catastrophic crash rising despite bull market. Well, that's the kind of fear that's out there, and people are being dragged into this market kicking and screaming. And I've been saying for the last 6, 7, 8 months, don't sell puts. You don't need protection. The environment is so favorable, things are going to work out. Now, let me give you a little backdrop. I wrote in the email, you'll see it, but I'll reinforce it, that we are going up about 2/3 of the day this year, and we're averaging about 3-point profit. So the market is going up and making a new high with 3 points. So keep that in mind. It's very important to realize the market is, if it goes down, it's in anywhere from 2 to 3 points below the previous low. And if it's going up, which it's been kicking and screaming going up, we're going up 2 to 3 points higher. That's very important, to understand, because we're going to have to be taking profits into some of these moves. All right, now let's get back to what we're doing here. We come down. You see this nice reversal bar? I kill for this bar. Kill for these bars. See, oversold. You get long. You start buying the S&Ps down in here. Let's say you can leg in. Now remember, there's a lot of ways to do this. I like legging in. I'm already long puts at 65 cents. So what am I looking to do? And now the puts are going up. They're now 75, 80 cents because the market is coming down. I'm looking to scale in lower, not higher. So now I start hedging by buying the S&Ps down in here. Okay, let's say I'm long 25 options. I'm now buying 15 S&Ps, give or take. Goes up, resistance, goes back to the high, sell it out. You pick up about 1.5 points on, let's say, 15 contract. Goes down, can't take out the low. This is a trade. We have on the 5-minute chart a rule that if we're within 1.5 points of a low on a 5-minute chart, 3 points of a low on a 30-minute chart. So it becomes the window. It becomes the low window or the high window. So we're within 1.5 points of this low. The bar turns color. Nice 2 red bars coming down. Blue bar. And look at this. Divergence. Nice divergence. Okay, so we'll buy some more back. So let's say I bought 15, sold 10. I can buy the 10 back. I can buy 8 back. I can buy 5 back. I can buy another 10 down here. Goes up. Guess what? Sell it again. Okay, make another 1.5 points on another 10, 15 options. We're talking $750, okay? And meanwhile, I can be buying puts. I can be buying puts back here at 65 cents, 60 cents. As the market goes up, the puts drop in value. As the market comes down, the puts increase in value. Then again, now we're starting to move above the mid-uni. This is a 20 exponential moving average, which can start to define support and resistance in trending moves. See, now we're starting to come out. See, we're starting to break out above the previous day's high. We're starting to come out of this big range. Last week I think we traded a low on the 14th about 1326. We're now trading up against 39. So we're starting to, and I'm starting to buy aggressively the option, the S&Ps in here, and buying the options. So again, what's going to happen is we end up with a simultaneous long puts around, the average price when it goes up, it's now trading around 50 cents. We're starting to buy a lot of puts. Starting to buy a lot of puts in here. We're starting to get long S&Ps. Okay, market comes down, you can buy more, and then we break out, and the market just runs. In here, you can take. I show a retest failure, but really, once you break out, you're not shorting here. But I'm just giving you an idea. See, we're still oversold. Oh, this is wrong. This should be overbought, guys. Okay, overbought. This should be overbought right here. All right. So anyway, we're overbought. You can take some profits and take some more profits, and you're getting in. You're getting in very strong. The oscillator reading is very strong. Even though we're not jammed, it's very strong. Okay, taking a little more profits, taking some more profits. Then we're starting to get up in here. Okay, we're starting to get up in here. All right, we're now at roughly 33. We're now 4 points above the high. We're now hitting maximum profit, 3 points, a little more. We're also at what I would call a retest failure. We have a way to calculate whether a market's in a trending mode or a trading range, and it's simply called the 27% rule. Now, you're not going to find this written in many books. I've been using it for 30 years. It's incredible. Whenever you get, and you can pick the times, okay? I'm picking the low of Tuesday, 1226, to the high, 1229, 13 points. You take 27% of 13. Let me give you a trick. Make it 30% of 13 is roughly 9, almost 4 points. Okay, it's 3.9. Take 10% off 3, so you get down to about 3.5. Okay, so you have a retest failure about 3.5 points above the 39 level, which puts you at roughly 1343.50. The high of the day is 1343. So we now have reached the maximum price before, and we're going to get a retracement. So we're looking to sell aggressively into this area. Okay, we're up against the 127. Okay, you'll see the 127 mentioned. Oh, no, it wasn't mentioned down. I don't really put it on the charts. I just use the word retest failure because it's showing you, even though you're making higher highs and higher lows, there's a level at which the market recognizes. You don't recognize it. I recognize it. My students recognize it. But you recognize we're at the 127. Now, there is generally 90% of the time there's a reaction off the 127. That's like the last vestige if you get caught on the short side or something like that, or caught on the long side, where the market will go. And when you're selling, let's say we start selling here. Forget everything else I told you. If we start selling here, we start selling here. The third tranche, you're in here. Okay, so let's say you sell 5 S&Ps, 10 S&Ps, 25 S&Ps, or some number, 1, 3, 5, whatever you find your capital position. Mine normally is 3, 5, 10, just to get started. So I would have 10. I would be short somewhere up in here, and here's my correction. Okay, here's a market coming down 1.5 points, 2 points. All of a sudden, I'm profitable on every trade. Plus, I'm making 2 points on that trade up there. So again, it's a very good rule. Marginal highs also. You can see we're making higher highs, but they're marginal. You can see the oscillator does get jammed, but basically it's overbought. We're going to come down. Okay, we're going to come down. Now remember, I'm long, let's say 50 S&Ps. I'm now up 4 points. Let's say, make it easy, 3. 3 times 50 is 1,500 bucks. That's about $7,500, $8,000, let's say. I'm now up $8,000. I bought 100 puts at, let's say, 55 cents. I now paid for all my puts. Now, what's important to recognize, we are now 4 S&P points away from the money with our puts. They're now trading 25 cents. This market can come down 4 points. I would give back all my profits, and my put would be back to 50 cents. So I would give back 9,000, 8,000, 7,000, whatever the number is. The market goes back to the breakout point. These puts offer little or no protection. So you're going to sell the majority of your S&Ps up here. Just the fact that you're going to pay for the puts. And you can re-enter. Now here's a situation where we're pulling back almost 40% of this move. Okay? And I'll show you something too later on when we get to here. See, I have the 27% up here, and I have the 27% down here. So I can see retest failure. But The real 27% is from the low of Tuesday to the high of here, and it stops out right there. Anyway, the advanced declines, look at this, guys. The advanced declines are 3 to 2. They were flat. The market's breaking out to new 2.5-year highs, and only 3 stocks are up for every 2 down. That's not very bullish. See, marginal highs. ADs don't confirm the highs. Okay? Now, thinking lower highs in here, if we come down, okay, I'm jumping ahead of myself, but I'm starting to think ahead. Okay, we come down. Now, this is a perfect pullback. It's coming back at a time in a trend move. Okay? In a trend move, we should pull back into the 1 o'clock low and then look to be long at 1 o'clock, going to new highs. You know, it can go to 44 or something like that. I hear CNBC all day long being told 45 and 50 are resistance areas. Now, those are the same idiots that were totally out of the market, you know, in 07 and totally invested in March of 09, and they're now telling you where to get out. Bullshit. They were out of the market in 09. They were long at 07 going to 09. I mean, it's the dumbest talking group of heads I've ever heard in my life. But anyway, they put them on there, okay, because they have nothing better to do. So anyway, look what happens. Perfect 40. 40 is a little down here. I now have time of day, one of the things I use to tell me what's happening. So I sold out. Let's say I'm long 50. I'm out of 40. I'm now buying 30 back. This is a layup trade. Oh, my God, down 2 points. Now I'm going to get long again. We're going to new highs. Okay? Guess what? This is not good. This is not good. I should be taking out the high. It's a time for the market to go higher. So the first thing I'm talking about is all these setups, all this driving, all this higher highs, all this higher lows are setting us up to go higher. Okay? Guess what? We don't go higher. Now remember, the expectation, how you trade without expectations is totally beyond me. You have to have an expectation. I have an expectation we're going to higher highs. We're not. Something's wrong. That's a very, very bad part.